Hi, I'm Ben Reppond. Today is January 11, 2023. Welcome to my YouTube broadcast. We are off to a good start this year. Market is going up mostly for the week or so that the market has been open this year, and that's a good sign. But as I pointed out in the other video, it's probably going to be a rough ride this year for various reasons. But we always want it to be positive, and so we'll take the good news when we have good news. So with that, I want to give you the dashboards. This is changed quite a bit from a week ago. The green dots on the right indicate that these indexes are higher than their moving averages from left to right, 20, 50, 100, and 200 day moving averages. And what's interesting to me is that in some cases, this kind of flipped around from last year. What was on top is on the bottom and vice versa. Not in all cases, but in some cases. So, but you can see is quite a few green dots. So it shows more strength in the market. The three indexes I want to focus on are the last three on the screen, the bottom three. DIA for the Dow Jones Industrial Average, SPY for the S&P 500, and QQQ for the NASDAQ 100. And what's interesting is it's a tale of two markets. The value stocks that grow, the Dow and blue chip stocks, all green. The moving average is above all four, or the stock is above all four moving averages. The bottom one, the NASDAQ 100, that index is below all four moving averages, and the S&P 500 is in the middle, and it is, above two and below two. So interesting, kind of quite a bit of a mixture. And bonds have been very weak. TLT is the 20-year government bond, and it's next to the top and is showing that it's above three of the four moving averages. So that's good for bonds. So, foreign markets, etc. The developed markets and the emerging markets, EFA and EEM, they are both above all four moving averages, showing, generally speaking, that the developed countries as well as the emerging countries are, generally speaking, have been stronger than the U.S. When we take the S&P 500 and break it apart into its 11 sectors, again, you see, compared to the last week or couple of weeks, a lot more green dots. So showing more strength among a lot of sectors that are stronger than in the past. What's interesting to me is the two that were on the top last year are on the bottom so far this year. And that is energy and healthcare. So healthcare is actually negative for the year, and energy is, almost break even. So I think that's interesting. And consumer discretionary and technology are still below all four moving averages. A number of them are above all four. Basic materials, financials, industrials, and consumer staples are above all four. Okay, now let's get to some charts, and you can see that we are still in a bear market. We've had about a week of strength in the market, but we're coming up on earnings later on this week. So that's where I think the headwind is going to start. But for now, there is strength on the short run. You can see on the very far right of the chart, there's some strength, but the overall direction is down. And, the S&P 500 is touching its 20-period moving average. This is an interesting chart to me because it says what I just showed you before on the dashboard, that the technology, growth companies, inside of the S&P 500 index, or you could even say the NASDAQ, inside of the S&P 500, or you could say the NASDAQ 100 itself, which is tech heavy, compared to the old economy stocks, the industrials and financials. You could say, okay, those are the value stocks, the old economy stocks have significantly outperformed the technology stocks or the growth stocks. What this relative strength chart shows is that if it goes down, it shows that it favors value by that much. If it goes up, that means it favors growth. So you can see it's not only down, but it's going down further, at least as of last Friday. When I compare the small cap index, IWM, Russell 2000 index, to the S&P 500, SPY, if it goes up, IWM is the numerator, SPY is the denominator. So if it goes up, that favors small cap. If it goes down, it favors large cap, S&P 500. So it's a 24-month weekly chart. So you can see at the end, for almost the entire year of 2022, it was not that much favoring either one. It kind of went up and down a lot. But it looks like it's gradually moving in an upward direction, which is slightly favoring small cap over large cap. And long-term government bond, this is a 36-month chart showing the direction of the long-term government bond, and it is in a bear market territory, been moving down. It has these periods where it goes up, but then it collapses. And so you see these two long periods, and at the very end, yes, it crossed up above its 20-period moving average, but it still is a very weak asset class. The dollar, the US dollar, is down, and I point the direction of it down in the short run. This is over the last 2 or 3 months where it has been going down. Prior to that, you can see the amazing trajectory of the dollar going up, but right now it is definitely showing weakness. Gold, measured by the ETF GLD, is been showing strength. It's been rising and rising. In the last couple of weeks, it's risen even more than silver. So that's interesting. And then here's the chart on silver. It's been going up also, but just the last couple of weeks hasn't shown the level of strength that gold has. And when you compare the two, putting silver as the numerator, gold or GLD as the denominator, you can see that it's actually favoring silver, in generally speaking, but in the last couple of weeks, gold had a little bit more of outperformance. And then Bitcoin, Bitcoin is not recovering. I mean, it's just, I don't know, I'm not a Bitcoin person. I'm not a proponent of Bitcoin. Anyone who wants to buy that, I respect that. You can do what you want to do. As an alternative currency, or an alternative to our currency, I would prefer precious metals, gold or silver. My preference is silver. And but there are people who are still proponents of Bitcoin. I think, of course, Sam Bankman-Fried and FTX, as well as the fall. Before that even happened, Bitcoin had fallen from approximately 65,000 down to about 16,000, a large fall. And so lost a lot of its value. And so people who had bought, and I'm sure a lot of people bought up in that 40, 50, 60,000 range, hopefully not too much. Some of them probably continued to buy on the way down, and it just kept dropping. So you can see where it's at. People can use it for whatever purpose they want, I think, but as far as an alternative to our currency, it's not something that I would personally do. Now, I'd shown this for about a year, so I expanded it out to 18 months to give you a little bigger picture on the volatility chart. And I put a black mark at about 24, so you can see, and I'm measuring that as kind of below that, is starting to enter a period of lower volatility or strength in the market. And during the past year or two, you can see it's just gone up and down a lot. So I call those head fakes. You think, okay, there's risk in the market. No, there's not risk in the market, and back and forth. And right now there appears to be diminishing risk in the market, and we'll see where that goes, but that's a good sign for right now. Asbury Research, this is as of Friday, Asbury Research gives 6 indicators that are, a lot of them are fundamental type indicators, and as of Friday, there were 4 of them that were still negative and 2 that were positive. So that's still an indication of bearish conditions even as of Friday. So, but with strength on Monday, and if there's any follow through on that, then that will start to shift over to be more green or positive. The cross-asset relative performance chart shows that certain assets are stronger than others. It's just a relative strength kind of chart measured by the ETFs in those categories. No surprise on any of these, but the broad market, S&P 500, is stronger than the NASDAQ 100. We showed that. Value stocks are stronger than growth stocks. We showed that. Developed and emerging countries are stronger than the U.S. Economy or the U.S. market, which is really measured by SPY, and we showed that. Bonds, corporate bonds or government bonds. Corporate bonds have been stronger and are stronger than government bonds, or we could say they're down less. And long-term bond prices have, in the short run, been stronger than short-term bond prices. And the 3 columns to the right are the last week, the last month, and the last quarter. So these are all pretty short-term periods. When we compare the U.S. to other countries, and if it's strong enough, if there's any kind of strength one way or the other, it will get a green box. If it's not decisive enough, it doesn't. It doesn't matter who it's favoring. So you'll see where it's favoring one or the other with a white box, but barely. So the ones I focus on are the green boxes. Where is the strength in the world? There are 14 countries that are, and a number of them are developing countries, and some are developed countries, but both. A stronger stock market than the U.S. in the last week, last month, and the last quarter. And all 3 regions of the world, the Eurozone, Pacific, and the emerging markets, all of those types or regions are stronger than the U.S. So I thought I would compare, do a relative strength chart just to show you. So when I say, okay, the developed countries, let's just say that's Europe and Japan and probably South Korea and Australia, Canada. When I show that, look how much stronger they are than the U.S. If it goes up, that favors the U.S. If it goes down, that's the degree to which it favors developed countries. So you can see that and what's interesting about this is about the time where the U.S. dollar kind of fell out of bed as well. So I think there's probably some kind of correlation on that. But there's more behind it than this chart says, and I'm just kind of reporting what the chart direction is. Then when I go over to the underdeveloped countries, it's the same thing. It's not quite as dramatic, but it's the same direction, favoring emerging markets over the U.S. But prior to that time, to just a few months ago, it was favoring the U.S. Gold and silver. Gold is $18.68 an ounce. This is the spot price onto which you need to add the premium. The premium is in the range of $100 per ounce, and it varies based on retailer. That's up 2.2% from the previous week. Silver is down 0.8%. We saw that on the silver chart. It's down slightly, $23.89. On top of that, you need to add the retail price or the markup, which is usually in the range of about $5. So $29 for, you probably could get some bullion for $29. When they give the news, I wonder if they look over to the bear sitting in the chair next to them and say, and now with a market update, I wonder if this bear has got anything to say. That's where we've been. We've been in bear market territory, and the bears have been in charge. And we don't yet know how 2023 is going to unfold. Are they going to stay in charge, or are they going to fade in the background and let the bulls take over? We don't know yet, but we're still in bear market territory. But let's hope for the best and be prepared, be nimble, have an open mind, be alert, watch who you get advice from, and I hope you have a good 2023. If you have comments or questions, leave them in the comment section below, and I'll try to answer them. Thank you.